All right. Hi, everyone. We are live. Welcome to Market Matters. My name is Katie Kuntz, and I'm joined, as always, by CNBC's senior stocks correspondent, Bob Pisani. Nice to see you, Bob. Busy day on Wall Street.
Yeah, tough day for the markets,
Yeah.
but we'll all get through it. We'll all
Yeah.
get out of it. Trust me. I've been here many times in the past.
Yeah, for sure. So let's just jump right into it. First things first, what has been driving stocks lower recently?
Well, with the Fed raising rates, the problem is the Fed does not have a clear fine-tuning mechanism to slow down the economy in the way that it wants to. It has very blunt instruments. What does that mean? Well, they've got an inflation problem. We haven't had this problem in 40 years where inflation, we've had this 2% inflation, which is kind of like perfect inflation, just enough. When you get 6, 7, 8% inflation, that's a real problem. And it erodes people's purchasing power dramatically. They start making wage demands and it get a spiral going. So the question is, you want a little bit inflation, but not too much. Now we have too much, and how do you stop it? And the Fed doesn't have a lot of instruments. Nobody does. The economy is really big and complicated. So really the only way you can do this is reduce demand. And reducing demand reduces the supply and just less demand for everything as well, and that will slow inflation down. The problem is you don't want to induce a recession. You don't want to raise rates so much that people completely stop buying a home. You want to slow down home price increases, but you don't want to stop people from buying homes. Well, that's not easy to control these things because it's really complicated. So usually what happens is the Federal Reserve, when in the instances where we've had really high inflation and they want to slow inflation down, they usually overshoot and create a recession. And so the stock market is now reacting to concerns that there's going to be a more serious recession. Now, you remember there was this concern in April and May, and it didn't happen, and earnings didn't fall apart. And so the market started rallying in June and July. And now the Federal Reserve has basically come out, Jay Powell, and said, well, inflation's still too high. We're just going to keep raising interest rates. And now they're concerned, the market's concerned, what's happening this week, is they're concerned they're going to overshoot. They're going to raise it too much. They're going to stay high too fast, and they're going to induce a recession or a more serious recession. And so this so-called soft landing is not going to happen. And what that means is earnings will probably come down a bit. And the question is, when do they stop? And when's the terminal rate? How high are they going to go? And we don't know the answer to that yet. So that's a problem. So there, on some levels, the Fed's winning. We can talk about that in a minute. But I think the real problem, just want to talk about the stock market. The stock market is, prices are determined by what people think earnings are going to look like in the near future, 6, 12 months down the road. Are they going up or down? And the other is the multiple, what the PE ratio. The PE ratio, I explained to people, is very important because that's the price you're willing to pay for that future stream of earnings. So if stock's $10 and you think in the next year it's going to make $1 in earnings, you're willing to pay, your multiple is 10. 10 divided by 1, the PE. You're willing to pay $10 for that $1 of earnings. What if I told you that the chances are we don't believe that dollar in earnings. We think it's only going to be, 80 cents or 50 cents. If it was 50 cents actual, then the multiple would be 20, 10 divided by 50 cents. That's a lot. That's historically, that multiple is expensive. And a lot of people might say, no way. And they drop the price. The price have to go down. So these PE ratios become very important. It's just, do I think it's worth spending $10 to buy that stock when it's $1 earnings? What if I don't believe it? Price might go down. So that's what's going on right now. We don't know what the right earnings level is. So right now, the market, current estimates are, earnings estimates will be up 8% in 2023. But we don't know if that's true or not. There's some people who think, well, that's not going to happen. They'll be flat next year. Other people think it'll be worse. In a recession, earnings tend to go down. Some people say, well, earnings could drop 20%. That's really bad for the market. So think about that. the range of estimates is really wide because we don't know what's going on, and we don't know what the right multiple is, that PE ratio. So historically, markets 15 to 17 times forward earnings. That's the multiple. I don't know. It's been as high as 21 this year. In a recession, you can go down to 13 to 15. So both earnings can go down and the multiple can go down. And this is how you get estimates of the stock market, the S&P 500, around 3,000. So for example, if you have a 15 multiple and $200 earnings next year, 15 times 200 is 3,000. That's how these people get these estimates. I think the S&P is going to end the year at 3,200. How do you get that number? What, do you pick it out of the air? Well, no, it's a combination of the dividend, which is very small, how much you think earnings are going to go up, and what you think that multiple is worth. And this is all a guessing game. And when the numbers are really wide, nobody can agree. Like, you can drive a truck through these estimates. One guy is very pessimistic, one guy's very optimistic. This is why you get this confusion in the stock market.
Yeah, for sure. So Bob, let's just jump into the Fed. Let's talk about the rate hike. So we saw another 75 basis point rate hike this week. What does that mean for global markets?
Well, remember, most of the global central banks, with the exception of Japan, has now followed the Federal Reserve. They're getting very, very aggressive. So you can see today with oil, oil is now $78, $79. Remember, this was, over 100 a few months ago, and was, in the mid 80s, for a good part of this week. So a way to look at this is proxies. Oil and metal stocks are proxies for global growth. You can have supply constraints, which we had in 2020 and 2021, that would drive up, say, the price of copper or the price of lumber. But generally, supply constraints, historically, because the markets operate efficiently, aren't that bad. It's demand that goes up and down. And oil at 78 right now, that's the lowest of the year. Essentially, you're going to say, well, we think that global growth is slowing. Metal stocks are also weaker, like watch Freeport-McMoran, a proxy for copper. So the global markets are saying that the efforts to raise interest rates is going to slow the global economy. Also, remember, we've got a ground war in Russia. That's a real big factor here in playing around with commodities and the European economy in general. There's all sorts of strange things going on here, but that Russia-Ukraine war is definitely a factor in the European economy.
So Bob, there's one company in particular that we got a few questions about this week, and that's Tesla. So can you just share some of your thoughts on Tesla with us?
I don't have any opinion on the price of Tesla or any of that. I don't do any of that, but I have a very strong opinion on Elon Musk. I think that he is one of the great geniuses of the 21st century. I think that the evidence is he is the Thomas Alva Edison of his day. Think about this. Nobody else has figured out a very efficient way, advanced battery storage technology for solar. Nobody else has done more to make electric vehicles a reality, done more to make them better, more efficient, go longer. And more importantly, for space, nobody else has talked about actually going to Mars. So the U.S. space program has been mired for decades. Musk has created a new rocket that might enable us to get to Mars someday. Nobody else has done that. No single individual has been able to do that. And now, of course, with Starlink, he's trying to create a global satellite link. Nobody else has done. These are big things, really big things. Do I find his behavior a little erratic? Yeah, I find that a little disturbing. I find his obsession with controlling Twitter to be disturbing. I find it disturbing because, to me, anybody can run Twitter. I don't think it's that important. What he was doing before, going to Mars, the solar business, the electric vehicle business, the satellite business, these are big things. These are things like almost anyone, only somebody on Elon Musk's level can pull off. Twitter is just such a silly distraction to me. I wish he'd stop. I wish he'd concentrate on the big things, because that's what we need Elon Musk for. So that's how strongly I feel about him. But he obviously feels Twitter's important to his brand or his megaphone for some reason. Maybe he desperately needs it. I wish he wouldn't. So I'm not going to give you any comment on where I think Tesla it's going. But I've been thumbs up on Elon Musk for more than a decade, and I see no reason to stop. I only wish he'd focus on the things that I think he truly will change the world in.
Yeah, well, time will tell, and we'll see what happens next with Elon Musk. So, Bob, you recently attended the Future Proof conference. I think we were all jealous of you being out in California in the sunny weather. But who did you talk to out there, and what did you learn?
Well, this was run by Josh Brown and Barry Ritholtz, and these are two friends of mine. Josh is frequently on CNBC, and I went to support them because they're friends of mine, but they had a very interesting idea about the financial conference. I go to financial conferences, Katie, and frankly, they're getting a little old and boring. There's a simple problem. There's too many conferences out there. There's too much of everything, frankly. There's too many podcasts. There's too many, not just financial conferences, there's too many biotech conferences. So there's so many of them that, and a lot of them aren't really worth going to. So, and the format is very old for conferences. So basically, you go to a conference, you sit in a wood panel room with a few people, then you go to another one where somebody talks, and then you go to another one, and then you have cocktails with somebody. And that format, while it might be useful, it's been around for a long time because it works, it's getting a little tired. And there's a bigger question about somebody like Josh wants, which is how do you get younger people to go to conference? How do you get younger people involved in the stock market, which is the best way to gain long-term wealth? How do you educate them? How do you inform them? And Josh and Barry's idea was, let's not do something in a conference room. Let's have it on a beach, Huntington Beach, California, on the beach. Let's have a conference. Let's have a lot of content, a lot of people talking about investing in crypto and stock market, bond market, what the usual stuff. But let's make it outdoors. Let's make it on the beach. And let's have a really big social component. Let's have parties. Let's have hip hop artists. Steve Leisman's band, my colleague, Stella, he has a great band, Stella Blues Band. I encourage you to check it out if you haven't online. It's a Grateful Dead cover band. They came and played. And I went to that. That was a lot of fun. So what I learned going to this is two things. Number one, they got 2,200 people to show up. That's a lot. That's a successful conference. 1,000 of them were financial advisors, and another 1,000 were basically young people, just young investors, not necessarily financial advisors, just came to hang out. And that's a good number. That's a lot. We need to get younger people more involved in the stock market, and we want them involved. And the disparities of wealth are very shocking. There's too many old people control the stock market. We want more of the wealth of the stock market distributed across age and gender and race lines. We want broader diversity in the stock market. And this is one way to try to figure out how to do that. The other thing that struck me that was very important, Katie, was social is as important as content here. It doesn't mean people don't go for the content. They do, but young people like to hang out, and they like to be with other young people. They like to socialize. They like to have a party. They like to go to a concert. That's part of the whole operation. This may not work for something that's strictly a financial conference, just financial professionals, but for investors, I think it was very successful, and I'm pretty sure they're going to do it again next year. So I really enjoyed myself, and I thought it was a great idea, and I thought it was a success.
That's great. It sounds like a lot of fun, and hopefully we do see more of those going forward for sure. So Bob, the next topic that I wanted to talk about was you have a new book coming out. Your book comes out October 18th, and it's all about the lessons that you've learned in life for investing over your 25 plus years at the stock exchange. So tell us a little bit about the book.
Yeah, it's called Shut Up and Keep Talking, Lessons on Life and Investing from the Floor of the New York Stock Exchange. And it's a summary of what I've learned for the last 25 years being on the floor. It's a very privileged position to be down here. I'm stocks correspondent for 25 years. But most journalists don't stay in a job 25 years. Most journalists move around. They do different things. I have chosen to stay here because I love the New York Stock Exchange. I love working for CNBC. It's a very privileged position. And I love the bell ringings, and I love, hanging out with traders and all of that. So what happens is if you stay around long enough, you kind of become a little bit of an old wise man. And if you have any sort of interest in this as a journalist, and I am a writer, you start thinking, well, what do I know? What have I learned over all these years? Do I know anything? What do I know? How do I know this? Do I still think it's true? And you have these questions, and that's what I did. I set out to write a book about a little bit about the journey I had, but what do I think I know about the markets? And it's very interesting. And the publisher met with me and said, look, you've been in a very unusual position on the floor of the New York Stock Exchange. We don't want you to write a memoir, but we want us to tell you about your personal involvement in all of this in the last 25 or 30 years. We want you to tell us a few stories about celebrities or amusing things that happened to you on the floor, people you met, people who said something that was interesting that stuck in your head. But we don't want a complete memoir. We also don't want a financial history, but we understand you're going to have financial history. You're going to explain things about what happened in the last 30 years. And so it's a sort of an amalgam of a quasi memoir and a quasi, financial history. One of the things I do that's very unusual is I actually talk about my own investments. Now, I think everybody knows we are restricted. I can't own individual stocks and bonds except for my own company stock, which is Comcast, and was General Electric. Other than that, I own mutual funds and ETFs. That's it. But even within that, you can own a wide variety of stuff. And I describe my own investing journey and a little bit about what I actually own. And a lot of people never do that. You have a lot of people talk about where they think the market is, blah, blah, blah. But nobody ever says, what do you actually own? You keep talking about this stuff. What do you own? It's amazing how many people never do. So I explain a little bit of my own investing journey and how I came to the conclusions that I came to. I'm a Jack Bogle disciple. Jack Bogle was the founder of Vanguard. He changed my life when I met him in the late 1990s, 97 I met him. And I'm still pretty much a believer in his basic precepts. And in the book, I explain what I think about the markets and how I look at them. It comes out, by the way, Katie, October 18th, and it's up on Amazon right now.
Yeah, for sure. Yeah, and everyone can check out Bob's profile. He has a tweet pinned up there with the link to pre-order. So we're very excited for that, Bob. And like you said, you really kind of dive in. You have the mix of the history, the interesting stories from the people that you've met, but also your own personal investing history. And I was wondering if you could tell us about maybe some mistakes that you might have made early on and along the way and what you learned from them.
Yeah, there's a whole chapter on this. You'd think I'm the stocks correspondent, therefore I'm some genius or something. And I wish I could tell you that. Unfortunately, it's not true. Very early on, and I'm talking 1993, I spent a lot of time around Jack Welch, who was my big boss. He was the CEO of General Electric. At the time, they owned NBC and CNBC. And in my 401k, that was the only stock I could own. So I bought it very aggressively because Jack Welch was like an icon. He was a god. He was one of the, he was manager, of the century, essentially. And he had enormous influence on corporate America. So I kept buying the stock. And by 1999, almost 50% of my 401k was GE stock. Now, those of you who don't know, generally, as a rule, you do not have a significant amount of your 401k in your company stock. It's too risky. That's just a standard rule. There's no percentage rule that exists, but certainly 10% is probably the maximum anybody reasonably would recommend. And at one point, at the height of the market in 1999, I had almost 50% in General Electric stock. That is a very serious error, and I paid very dearly for that error. And it wasn't like, oh, I didn't know that, and I only knew it years ago later, 15 years later. I did know that. And this is one of the things that's very difficult to describe to people. This goes into the area of behavioral economics, that you can know things intellectually, but emotionally you don't. you don't get it. And when I thought about why did I allow that to happen when I knew that I shouldn't be doing that, I realized I was very much under the thrall of Jack Welch and General Electric. I just thought they could do no wrong. That's called overconfidence. That is a very classic behavioral economics mistake. Thinking that either you or the people around you, in this case Jack Welch, are infallible, and they're not. And for that fundamental error, I paid very dearly. And I also took too long to recognize that I was over invested. So I was over invested, and then I took too long to recognize that fact. And I describe that in the book, and it's very painful, believe me, because like I said, it's not like I didn't know it. I did know it, and I still didn't act. And this is how difficult it is to change behavior. This is why I'm very interested and became a real believer in behavioral economics, because I saw the stupid things I did. And I hope that's a lesson for some people to sort of understand that painful chapter I wrote describing what happened to me.
Yeah, well, I think there's so much that we can learn from our own mistakes, from behavioral finance, and just at least being more aware of those kind of situations that people can naturally fall into. So definitely lots to read about there. And then you also mentioned that you've met some very interesting people along the way over the past 25 plus years. So I was wondering if you could tell us about some of the most interesting or influential people.
Well, the publishers were very insistent. They said, Bob, the thing that'll make the book fun or interesting is tell us some stories about people you met on the floor, or it's offhanded comments people made to you that you really kind of stuck with you. So there's a whole bunch of stories in there. But one of the most interesting people I met, which is a total surprise to me, was Barry Manilow, the singer. And he came down on the floor, gosh, 6-7 years ago. He was promoting an album and a tour. And I'm not a Barry Manilow fan. I'm a rock and roll. Look, there's a Rolling Stone poster behind me. I'm a Led Zeppelin guy. Hardly a Barry Manilow fan. But he'd done an interview with Bill Griffith, my colleague. And this is one of the great things about being on the floor. It was after hours. There was nobody around. Barry Manilow walks off, says hi to Bill. And he's just standing next to me. And I said, you know, Barry, two things, just like two quick questions. You were a jingle writer, right? And he said, yeah. You actually did write the State Farm jingle, like a good neighbor, State Farm is there. You did write that, right? He said, oh yeah. Yeah, I sold it for $500, and I never regretted it. I was a jingle writer, and he was very proud of that. And I knew that before that story was known. But then I said, you know, I don't understand it. You just sold 15,000 seats at this gigantic stadium in Long Island, and you haven't had a hit for a number of years. It's amazing how loyal your fan base is. And he launched into a little comment about his career that was very profound to me. He said, you know, in the beginning, 70s, I had a whole bunch of hits. I was really big and famous, and you know, the 80s a little less so, but I kept doing what I wanted to do, and I learned how not to try to write songs that were deliberate hits. I learned to please myself and do what I want, and had a very satisfying career. Not as much big hits, but I just kept doing what I wanted to do, and I stayed at it so long that eventually some people started calling me a legend. And he said, now I have a sort of like other renewed thing, because now I'm a legend. I thought this was fairly profound insight into his career, but into careers in general, because the sort of takeaway from what he was saying was a lot of people falter in the middle part of their career. That's the really tough part, because you've already done something, and he had done something. And all of a sudden you're in the middle part of your career. And that's where a lot of people get bored and leave, or they kind of muddle through and don't do so well. They just kind of just slog on. But his point was, I got to the middle part of my career, and rather than just, you know, walk away because I really like it, I just kept doing, and I learned how to sort of please myself more and not be so worried about having hits, and I was fine. And then I emerged on the other end, and now people call me a legend. And so what happens here is, and this happened to me, I decided 20 years ago to stay at this job. I could have left and done something else, gone on some other journalism career, but I love doing this, just like he did. And I stayed with it in that middle part of the career. And now I'm sort of well known. It's called, Katie, inch wide and mile deep. I'm very well known for a little part of the world called the stock market, because like Barry Manilow, sticking to what he loved, I kind of stuck to what I love. And so my point was, I spent all of 15 minutes with this guy, and I was profoundly impressed with what he had to say. I just thought it had a very good perspective on his career and what it had to say with other people. And I talk about meetings with Walter Cronkite and Aretha Franklin and Mike Tyson and some of the interesting things they had to say in the book. So it was very profound and interesting for me. There's an example, just an offhand comment that you weren't expecting much from the guy and turned out to be very interesting.
Yeah, exactly. Definitely points to your character, Bob, of keeping an open mind about people. And, you know, even if you weren't a big Barry Manilow fan beforehand, you know, you can learn a lot from people.
Yep.
And I also will say, you mentioned your posters. We can tease that there is some information about your posters in there, Bob.
Yes. Next time, I'm going to talk about a Black Sabbath poster. And here's another one. I wasn't into Black Sabbath either in the 1970s, but I collect 1960s rock posters. There you see a Rolling Stones poster behind me. That's the 72 tour. And I made a bid on a Black Sabbath poster. And I don't want to talk about it now. I'll tell you about it next time. But I will tell you, this is another lesson in behavioral economics. I really messed up the bid on this. And I'll explain why next time we get together, what it means for people who might want to buy something or even participate in an auction on something.
Well, there's something for everyone in this book, Bob. Shut Up and Keep Talking. Great title. That's out October 18th. So yeah, we're excited. Thanks, Bob.
By the way, people ask me, how do I get the title? That's like the most asked thing.
I'm sure.
You know, we have these devices. This is called earpieces, but they're called IFBs, interruptible foldback. And you put them in the control room. This wireless control room can talk to you about, okay, Bob, you're coming up next. And people ask me a lot, like, what do they say to you while you're standing there? Is there commands or anything? And well, you can say anything if you want, but most of the time people are busy. The producers are busy, and it's usually two different commands. One is rap. Rap is short for shut up, stop talking. And the other is stretch. Stretch means keep going, keep talking. So basically, you can say anything you want, but basically the commands that you hear are some variation on shut up and keep talking. And I described that to the book publisher, and they said, that's it. That's the title of the book. Shut up and keep talking. That's how you do it.
Well, that's great. And thanks for answering all of our questions, as always, Bob. Really appreciate it.
Appreciate it. Thank you, everybody.
Yeah, we'll talk again soon.
Okay.